Alrighty. How you guys doing today? Cool. So I'm the business finance tutor, um, and what I plan to be doing is, I know Professor White, she put out like a composition of the test. I'm going to be trying to mimic those using problems I pulled out from the practice questions from like chapters 4 all the way to now, using the different stuff she had given. I know she had given a couple of time value money, some stock stuff, some capital structure and budgeting stuff, but I pulled a decent amount of problems so we can kind of go through them like one by one. And if you guys have any specific questions if you didn't understand the problem, if you'd like me to repeat something, just let me know. I guess we'll get started then. So what I did here is we're going to start from like chapters 4 to 5 using time value money, which is pretty straightforward. I'm going to see if I can zoom in on this because I don't know how I would zoom in. There we go. Oop, nope. All right, so can you guys see that well? Is that pretty good? Alrighty. So let's see. Hopefully you guys have financial calculators because it's kind of important for this test. So yeah, first problem. So what you want to do is just what I would suggest to do when looking over, when going through the test, is to just kind of write down what you know while reading the problem. So it says how much money. It says how much money do you need to place in a bank account which pays 6% annual rate. So you know right off. Time value money is just going to be dealing with the calculator stuff. So you know 6% is going to be your I per year. I per year. In order to have 500 at the end of 7 years. So we know 500 is our future value. So you can kind of label 500 as your future value. Since this is an annual thing, we know our periods per year will be 1 per year. And I guess you could put it off to the side, 1 period per year. And we know we're doing 7 years. So n would equal 7 because 7 times 1 is 7. And here, I'm going to try to do it on the calculator. Is that like bright enough? I don't know. Can you guys see the numbers on here? Or not really? Is that better? No. Nah, it's not that great. Well, we'll just go there, and then if you guys have troubles, I'll look over that. So here we say how much money do you need to place in the bank account. So here we're solving for your present value. So we're just going to go ahead and just kind of plug these numbers in. So you're just going to do 500 as your future. Now remember, when doing time value of money, 90% of the time you're going to have a negative present value and a positive future value. You can change those signs either way. It doesn't matter. Just know that you're having alternating signs on both of them. So here, I mean, we can make future value 500. I'm going to try to do this so it's not like, that's just too dark. All right, sorry about that. So we're going to put 500 as your future value. We don't have any payments because we're not doing any kind of annuity here. So you don't need to worry about the payment key. Your I per year is 6. Your N is 7 because 7 times 1 period per year, 7. And you should get a present value of the 332.53. Does that make sense, everyone? It's just a simple calculator problem. And if you guys have any like trouble inputting it, just let me know after we're finished so I can kind of look over what you guys are doing. So this one's pretty straightforward. It's just the 332. We're looking for present value 332.53. All right, so that's one of like the simpler time value money questions. And let's move on. So how much money we need to, so here, kind of Same concept. How much money do you need to place in an account now to have 1,000 10 years from now? So here we're obviously solving for PV. We know our FV is going to be 1,000. It doesn't matter whether you make your 1,000 positive or negative. That negative positive stuff kind of matters and when it comes to the bond stuff. So, and I'll go over that too. So we have 8% as our I, 8.5%. Now here it says compounded monthly. So you want to be careful and you want to change your periods per year to 12. If you don't change it to 12, it's going to give you a wrong answer. And I wouldn't doubt where if you didn't change it to 12, the answer you get would be an answer on the test. So it could easily trick you guys. So yeah. 12 periods per year. So here we're solving for PV, and our N is going to be, now N is going to be 120. We have 12 periods per year over 10 years. So it's basically 12 times 10. So our N is going to be 120. And then here you just plugging it in the calculator. 8.5 present value. And you should get a present value of so you should get a present value of the 429. Does that make sense, everybody? Pretty straightforward calculation. You don't want to. These should be like the easier questions on the test if you come up with those. Cool. So, all right. So the next one is kind of a harder time value money because you have two different setups you want to be careful of that you're doing. So let's see what we do here. So how much do you have to deposit today so you can withdraw $50,000 a year at the end of the years 5 through 9 and $25,000 at the end of year 10. So here we essentially have two time value money problems in one. I'm going to deal with the $25,000 first because that one's a little easier. So here, all right. So here we have an annuity from the years 5 through 9 of $50,000. So I'll start with that one first. So since you have an annuity for $50,000, you're going to set that as your payment at the end of years 5 through 9. Now here, you want to be careful on what you set your N as. You're not going to set your N as, you have a question? Oh, I'm sorry. Oh, yeah. So here you want to be careful on how you set up your N. Your N isn't going to be 9 or it's not going to be 5. You're going to count how many years you're pulling it out. So what I would do is, I know it's pretty simple, but I like to just write down the years that I'm pulling out the money. So here we have 1, 2, 3, 4, 5 years. So our N for this 50,000 annuity will be 5. So be sure to count your years. It's easy to make a mistake with that. 5,000. We have an annual interest rate of 8%, and it says annual rate, so we can change back to 1 per year. Since the last round we did 12 per year, that's going to save on your calculator, so you want to change back to 1 per year. All right. So, okay. So 50,000, and I'm just going to put this in the calculator, and we should get. Let me write down. All right. So here, another thing I would suggest to do is to write your number line. It really helps to really kind of get a visual understanding of what money you're moving from, whether you're moving backwards or forwards. So here we have, so we have 50K here. So we have this annuity of 50K, and then at the end of year 10, we have 25,000. So here it can kind of give you like a visual representation of what we're doing. So here we're gonna 50,000. Our percent here is going to be 8%. And I'm just gonna plug this in the calculator and let's see what we get. So here, when we input this calculation on the calculator, we end up with a PV of 199. However, this 199, 635, this 199 isn't the present value at year 0. It's the present value at year 4. So what you want to do is kind of mark down, since we did this annuity, it brings all this money to year 4. And now we're going to bring back our 199 that number to year 0. So that now it becomes kind of like a simpler problem like number 1, where we have a future value of the 199. Now we're basically counting back how many years to 0. So we're 1, 2, 3, 4. We have n equals 4. Make sure I'm not crooked. Still the same interest rate, still the same periods per year, and let's see what we get for our present value. Alrighty, so yes. Yeah, I'm sorry, I misspoke. I came up with the wrong number. Give me 1 second. Sorry about that, guys. Okay. Oh, I made the mistake. After you do your calculation, always clear your calculator, because that the values you put from the other calculations can mess up calculations, which what happened to me. Yeah. Yes. Yep. That's a good question, or a good point. And since we have an annuity here, another thing you can do is do a cash flow button. I'm not a big fan of that, because I always rely too much on the cash flows button. The cash flows, what you do is through the years 0 through 4, you're going to have 0 cash flow. So, and you guys are familiar with the cash flow button, correct? So you're going to do you're going to put 0 in for cash flows for years 0 through 4. And when you get to year 5, you're going to put 50,000 for 5 through 9. So you're going to press the cash flow buttons 4 more times. And then on year 10, you can put 25,000 as your ending cash flow. You put in your percentage of, so let me rewrite that for you guys. Let's see. Okay. Cash flows 0, 2, 5, 0. That's 50,000, and then cash flow on 10 equals 25,000. Sorry about the confusion, guys. So yeah, so when you have you can percentage and then hit Shift MPV, and that's another way of getting your money at year 0. So for that, you should end up with 158,318. Does that make sense to everyone with the cash flow stuff? I know it's a little, sorry, I misspoke with the numbers there, but yeah, so that's another way you can do that. Does that make sense, everybody? Hope I didn't confuse you guys, sorry. Alrighty. Next, time value money. Here. Okay. Suppose we invest 500 at the end of each month. 500 is our payment. And since it says at the end of each month, we're going to change back 12 per year. And when you retire at the end of your 35-year career, your account is worth $4 million. So we know our future value is going to be $1 million. What annual rate of return did you earn over the 35 years? So here, you're solving for I. N is going to be 5 years times 12 periods per year over 35 years, and you should get 420 months over that 35-year period. Here they're asking for what is your interest rate, and then you're just getting everything in your calculator, and you should get 1281. Yeah, you just want to be careful on how you put things. So here, you want to make your payments negative because you're putting in money on those months. Do you have a question? Oh, I'm sorry. I'm very used to this. So yeah, if you have trouble thinking about like which is positive, which is negative, just kind of think about it in kind of like a logical sense. At the end of every month, we're putting in money, so that's money coming away from us. So that will be a negative. And then at the end of the 35 years, we have $4 million that we can pull out. So that can be money coming towards us, which will be a positive. So here you're just plugging in all your values, and you should get 1281 as your percentage. Does that make sense, everybody? Cool. All right. So here, kind of the same concept, except we're kind of actually, it's almost kind of like the same problem. We're solving for interest rate. So, there. Suppose you pay $41,625 for an annuity that will pay you $5,000 per year. So right off the bat, you're paying $41K for this annuity. So right now, you can make PV negative $41,625. Does that make sense? And that'll pay you $5,000 per year. So now you're getting a payment as a positive of $5,000 at the end of each of the next 15 years. So here, we don't have payments of 12. You want to change back to 1 per year. So periods per year, we 1. And your N, we have 15 years. N times 1 will be 15. And then you're solving for your interest rate. And your interest rate should be 846. Does that make sense? Here is just calculator stuff. So just think about logically, whether you have a negative cash outflow or a positive inflow of money. So yeah, that's time. I think I have one more. Yeah, I have a couple more. Alrighty. So let's see here. Cool. Alrighty. Here, now we're actually solving for how many compounding periods it's going to take to grow this money. So here, just kind of what you. So we deposited 2,000, so we can make PV negative 2,000. It's going to pay you interest of 12%. It says annually, so we can change our periods to 1 per year. Actually, no. Here they say annually, but technically it says it's being compounded semi-annually. So actually you want to change your periods to. If it doesn't say, a periodic investment throughout the year, just assume it to be 1. So periods per year is going to be 2. And we want to grow our money to a future value of $67.98. And then here you're just plugging it in on your calculator, and and you should get 21 compounding months. Yeah. So here, question?
Why do you put two for handwriting?
Oh, this is a future, sorry. Handwriting, sorry. Yeah, this is a F and this is a P. Sorry about that. So yeah, you just plug it in the calculator. So be careful of your negatives. They can really mess things up. And then here you're solving for your n. Does that make sense, everyone? Cool. Alrighty. So here, I think this is the last time value money. So at 8% compounded annually, how long would it take 750 to double? So here we know our present value is going to be 750. They don't necessarily tell us what our future value is, but they tell us we want to double it. So we're just going to double 750. This is a P, this is an F, and our future value is going to be 1500. 8% is your interest, and we want to solve for here, since this is compounded annually. When we solve for n, it's going to give us years, and I believe that will be and then your I is 8%. Periods per year is 1. Here you're solving for n again, and in this case, n should be 9 years. And you put it in your calculator. You want to make one of these. It doesn't really matter which one. You could think about it where we're putting in 750 now, so we can make this negative and make this positive, or you can make this negative positive. It doesn't really matter. You're going to get the same answer, just a negative sign. Well, actually, in this case, it doesn't matter because we're going to get 9 years as our n. Does that make sense? That's time value money. It's kind of pretty straightforward. So yeah. Okay. So I know she has a couple bond questions. You have a question?
Yeah, I was just going to say, when it comes to doubling your money, you can just throw the interest rate over 72.
Yeah, that can work too. The thing with time value money is you can arrive at your answer multiple ways. I'm just kind of going through the calculator way, but yeah, if you figure out a way that makes sense to you, more power to you. That's awesome. But yeah, so that's another way of solving for that. Cool. All right, so bonds. So our corporate bond has 13% coupon rate. Now remember, your 13% coupon rate is going to be the number connected to your payment. And the 13% coupon rate is always going to be multiplied times the par value, which is 99% of the time always going to be 1,000. So here we pay interest semi-annual, so we know right off the bat periods per year is 2. And another thing with bonds, a lot of them are always going to be semi-annual. A majority of what I see on the practice stuff and the quizzes, a lot of it's semi-annual. 13% coupon rate. So with 13% coupon rate, we can find our payment by doing 13% times 1,000, which is our par value, and then dividing that number by 2 times 1/2. So your payment should be 65. Does that make sense? All I'm doing is multiplying the percentage times the par value divided by 2. So that's your payment. Par value. Par value is always your future value, and they want to find intrinsic value. So that means you want to find what your present value is, and our interest is going to be 10%. Does that make sense? Just kind of writing down what you know. And then here, you're just plugging stuff in your calculator. Now, I do want to stress that your payment and your future value have to be the same sign. So just, you can make, if you put both of these in as a positive number, your PV is going to come out as a negative number. Or if you make them both negative, your PV will come out a positive number. But the main thing I do want to stress is that PV, or future value and payment, need to be the same sign when it comes to bonds. So yeah, there's that. So yeah, so you plug everything in, and I believe you get a bond of 1231. Let's see. Yeah. So 1231, unless I looked at the wrong number. But yeah. So that's pretty much the bond stuff. Any questions? Cool. So more bond stuff. Corporation issued bonds 23 years ago. The bonds have a coupon of 12%. So we know our payment is going to be that 12% times that 1,000. So right off the bat, we can go ahead and write that down. And oh, sorry. Yep. 12% times 1,000 and semi-annual payments. So we're going to divide this by 2. So your payment is going to be 60. Par value is 1,000, so that's future value of 1,000. Bonds have 7 years left to mature. Since it's semi-annual, you're going to do 7 times 2, so your N is going to be 14. And the required rate of return is 10%. So here, what is the intrinsic value? You're just solving for PV. So you put everything in the calculator, and you should get 1099 off of that. Does that make sense, everyone? So this is kind of similar to like time value of money with just a little extra step of that payment. So yeah. Alrighty, so those are the 2 bond questions I pulled. Yeah. Now we're going to go on to cost of capital or stock questions. There's a lot of mixture of these, so. Medical supply company has a beta of 1.55, so you know right off the bat, your beta is 1.55. Thank you. So your beta is 1.55, and they recently paid a common stock dividend of $3.47. So the hint here is recently paid, so that means our D0 is going to be this $3.47. And return on treasury. Now remember, treasury securities are always risk-free. So your risk-free rate is going to be that 7.5%. And the market, S&P is going to be your market rate. So your market is going to be 0.12. What is the required rate of return on the common stock? So this is going to use your Kaplan equation, and your Kaplan equation will be provided on the test. I'm certain of. So here you're just plugging in the Kaplan equation, and that is going to be, sorry, I'm going to cover up my numbers, but KCS. So this is your Kaplan equation. So this is going to be the required rate on the common stock, and here you're just plugging in numbers. Bless you. However, bless you. So here we don't really need our dividend. It's just there to kind of throw us off because we only need our risk-free rate and our market rate and our beta. So we don't even need that dividend. So here you're just plugging in numbers. So yeah, 0.075. So here, what I suggest doing on the calculator is doing this first, doing the parentheses first, multiplying it by the 1.55, and then adding that 0.075 at the end. So yeah, that should be, yeah. So here, this should be 14.48% when you do all the calculations for that. So this one is kind of tricky. You just want to realize that usually when you see a problem that gives you a beta, that's a good hint to use the Kaplan equation. So yeah, there's that. Does that make sense? Everyone? Cool. All right. Okay. So here, more stock questions. Here we're using preferred stock, so you want to use the preferred stock formula. Paid annual dividends of $6.75. Now we know with preferred stock there is no D0 when it comes to preferred stock. There's no growth on preferred stock, so you don't have to worry about a D1 or a D0. So you know your dividend is $6.75. The par value is 100, and they require a 9% rate of return. So you know that your K is Okay, KPS equals 0.09. What is the intrinsic value of the preferred stock? Intrinsic value is going to be VPS equals your dividend over your preferred stock. Here, your par value is there to throw you off. So here we're just doing 675 divided by 0.09. Yeah. And then that should give you, I believe, 75. Yeah, 75. So yeah, this was pretty straightforward. It's just a quick little formula. Next one. We're doing common stock. So here we do have to worry about a growth rate to the common stock. They say they recently paid a dividend of 260. So you know your D0 is going to be 260. They recently paid out 50% as earnings as dividends and retains the rest. So here, one of the formulas on the test will be G equals ROE times R. Now what that means is your return on equity times the retention rate that you invest back into the company. So here, we put 50% as dividends and we retained 50% into investment. So we know that our R is going to be 0.5. And we know our return on equity is going to be 15%. So that's 0.05. And this will give you a growth rate of 0.075. Does that make sense? Just a quick calculation. You just want to be careful with what you're dealing with when it comes to the retention for investment. So yeah. So with that being said, we know our D0 is 260. We know our growth rate is 0.75. So we can find our D1. And D1 is going to be D0 times 1 plus the growth rate. So when you put this in a calculator, you should get 279.50. You don't really have to do these 4 decimals, but I like to do them anyways. So you know your D1 is 279. The investors require 12% rate of return. So your K is 12. And what is the intrinsic value of the common stock? So intrinsic value of the common stock is going to be, or actually VCS equals your D1 over your K minus the growth rate. We know our K, we know our G, and we know our D1. So here it's just plugging in numbers again. Your K is 12. Yeah, and you should end up with a intrinsic value of 62.11. What you could do on the calculator is you could input 279 first, divide, and then start your parentheses and do the 0.12 minus 0.075. But however you guys do it, it's cool as long as you get the right answer, obviously. So yeah, that's one of the other stock problems that probably most common on the test. I would assume so, where it's just they give you value, they give you growth rate, and you just got to figure out what. Yes.
Is there a light on that thing?
I'm not sure. Can we? Let me see if I can turn on these lights. Cool. Can you guys still see the board? Oh. Is there a light on here? Not really sure how to do that, but let's see. There should be a light here, but I'm not really sure. I'll read them out. Hopefully you guys can see them. And if anything, this is a live stream, so you guys can go back and rewatch it if anything. So yeah. So I'm gonna try to keep things like above, like in this area, so you guys can see without that shadow. So yeah, so that's one of the common stock problems. It's not too bad. It's just kind of writing down what you know and just writing down the formula. All right, so here, this is a buy or sell question. So this is a purely calculator question. So it says here, in 1 year they will pay a common stock dividend of $4.35. So let's see. Okay. So they pay common stock dividend of $1.35. So here we know your payment will be $4.35. You predict that you will sell your stock for $57 after year 1. So that $57 will be your future value. Now remember, this is kind of this is similar to the bonds where you want to keep these two the same. How much would you be willing to pay for now? So that's going to, you're solving for PV. Okay, cool. Let me turn this off. All right, sorry about that. Is there a light on this? Okay, I will. Okay, cool. Sorry about that, guys. All right. So we have our payment of $4.35. We have a future value of $57. We're looking for how much we pay for now. So that's the present value, and your rate should be 16%. And then here you're just plugging in the numbers. Oh, and it says 1 year, so N is 1. And it doesn't say whether it's semi-annual, so just assume it to be 1. And when you plug everything in, you should get, I believe, let's see. Yeah. So you would get 52.89. So here is just a simple calculator. It's a buy or sell question, so you want to just know that it's a calculator problem. So yeah. Alright, so those were a couple of the stock questions. Now, actually we still have some more. This is kind of similar to this one. We recently paid a stock dividend of $2.75, so your D0 is $2.75. Then the required rate of return is 18%, so you know your I is 18%. 30% on equity, so you know your ROE is 30%. And they pay 50% as dividends and reinvest 45. So your 45 will be your R, 0.45. And what is the value of the stock? So this is common stock, so you want to use the common stock formula, which is dividends K minus G. All right, so first we need to find our D1. So we can find that by finding our growth rate, and we find our growth rate by doing 30% times the 45. So you should get a growth rate of 1350. And now, since we know our growth rate, we can find our D1 by doing 1 plus the growth rate times D0. So you should get a D1 of 312. Oops, sorry. You know your K is, actually, yeah, there should be K. Your K is going to be 18%. And your growth rate is 1350. And here you just plug in numbers in. 1350. And yeah. So let's see, and that should give you 69 as your value of the stock. So yeah, just another stock problem. You just want to, pull out what you know, write down the dividend stuff, and make sure you grow your dividends for that 1 year. So yeah, that's that. Does that make sense, everybody? Cool. Alrighty. So here, this is kind of working off capital structure / budgeting. You have a question? Oh, sorry. Is that better? Cool. So let me just do this. Alrighty. Sorry. So here, All right, so here we're kind of working off capital budgeting. We're trying to find we have different projects, and we want to find different things with them. So here, there we go. So here it says mutually exclusive. What you want to do is that basically means you got to choose one or the other. Turn on the light, or okay. Okay. Alrighty. So can you guys see this or not really? All right, so I'm turning them off. Sorry about that, guys. All right, that's a little better. Yeah. Alrighty. So here we have two different projects. We got to choose between one or the other because it's mutually exclusive. Here, what is the IRR of the project? So here, you're going to use your cash flows button, and you're just inputting them in 1 year at a time. So here, we only care about the IRR of project A. So here, you're just going to do cash flow of negative 32,400, and put all these positive cash flows accordingly. So when you plug them in, be sure to clear your calculator because I know we just did a calculator problem. So be sure to clear it. The 32,400. Alrighty. So you input all your cash flows. You put in your percent of 12%. And here you should press Shift IRR, and this will give you an IRR of 1632. That makes sense. So this, when it comes to IRR, it's just almost strictly calculator. You're just going to plug it in and get your IRR from that. Payback period. So payback period, it's pretty straightforward. It's just kind of saying, since we're paying 14,400 for this project, how soon can we get our money back using the cash flows from our for the years? So here, what I like to do here. It's kind of silly, but I like to just draw the number line. So we have 14,400, and we're kind of covering. So we want the payback. Oh nope, we want it for the 32,400. Sorry. So we want the payback period for project A, and we're just seeing how long would it take for us to recover the 3,200. So I like to just go year by year. And obviously, this 9,600 is going to not cover everything, so we're just going to keep going. Another 9,600. So let's see. So what you can do is you can just start off by 3,200 and then subtract each successive year. So minus 96, minus another 96. Here, our remaining balance is 13,200. So here, I just kind of do this. Here, this will end up at 13,200. Obviously, we can still go another year of the 96. Yeah, so minus another 96. So we end up with 3,600. Now, we know our 8,400 is definitely going to cover our 3,600. So what you can do is just kind of form a ratio of how much you have remaining over how much you're going to earn in the next year. So that'll be 3,600 divided by 8,400, and that'll be, so you divide this by the 8,400, and this is 0.42, and we went 3 years plus this 0.42, and your payback would be the 3.43 rounding errors here. So yeah, that's payback period. It's pretty straightforward. It's nothing to be too concerned about. All right. Profitability index. Here, you're going to use your cash flows button again. So what you want to do is you clear your calculator and then input your cash flows. So let's see, 14,400. All right, so after you input your things, put in your interest. Here you want to solve for MPV. So when you solve for MPV, you should get 18. Sorry, I messed up again. All right. Okay, yeah. So here you should get 1842 as your. Oh, actually, sorry. we're doing project A. I'm doing project B. Sorry about that. So do your cash flows for the NPV. You should end up with 3,800 as your NPV. Now, when it comes to profitability index, all you're doing is take your NPV, add your initial outlay, and then divide by that same initial outlay, and that is your profitability index. So you do that with the project A. I believe you end up with an NPV of some number in the 3,500 range. You're going to add your 32,400 back in, and then divide by that 32,400, and that'll give you a profitability index of 1.117. Does that make sense? It's not too bad. It's just kind of remembering what the profitability index actually is. Cool. Here, calculate net present value, which I kind of did. Just after you do the profitability index, be sure to clear your calculator. Do the cash flows button again, and you should get NPV of 1842. Does that make sense? So pretty straightforward when it comes to that. Okay, so I'll give you guys a minute to write that stuff down. Okay. So here we're going to go into our capital budgeting. So this is when it comes to the initial outlay, the annual cash flows, and the terminal cash flow at the end of the years. Alrighty. So here we got a couple of things we got to worry about. So first, let's work on the initial outlay. Now, your initial outlay formula, kind of write it off over here, would be, the purchase price of the project plus the shipping and installation, and that is going to be your depreciable base, or your depreciable asset, same thing. You got to add your net working capital. And here we have plus or minus the gains from replacing something. In this case, we're not replacing anything, so we don't have to worry about this gain or loss from that. And that would be your initial outlay, right? So you're going to purchase this thing for $560K. It doesn't say anything about. Yeah, so we don't have to worry about adding that. So that's kind of like a 0. So your depreciable base would be 560. Now this 560 is important because we're going to use this for our depreciation for our annual cash flow. All right. So here, after we do this, outlay. Now keep in mind, technically all of these are negatives. I'm just kind of adding them to just so that it's just one big negative basically. So your initial outlay will be this 590K. Now you're going to work on your annual cash flow. So here you want to be careful on reading the depreciation, because you could use something more than you depreciate it, so you would only depreciate for those for that amount, and then do more annual cash flows afterwards. So I'll show you here. So first, let's find our depreciation expense. Our depreciation expense would be this 560 divided by 5 years. So you should end up with a depreciation of 110. And now the formula, or kind of like the setup for annual cash flows, that's going to be incremental revenues plus or minus incremental cost. Now, the reason why incremental cost can be a plus or minus is because if you can save costs by buying a machine, that will add to your revenues. That's why that can be a plus or minus. Subtract your depreciation. Let's see. And that's going to give you your EBIT in a sense. You're going to minus your taxes. And then you're going to add back your depreciation. Oh, this is going to give you your EBT. And then you add back your, or EAT in this case. And then you're going to add back your depreciation. And this will be your annual cash flows for the years. So here it says we're going to increase revenues by 180. So that's positive, and it will increase costs. So here we're going to be incurring more costs, so that's going to be a subtraction, 50,000. And we're going to subtract our depreciation, which was 112, which I'll kind of write that over here. Divided by 5, it's 112. 112K, cool. So your earnings come out to be 18,000. Your tax rate is 34%. So you're going to do taxes on this 18,000. You end up with a tax expense of 6120. So you subtract that, and that's going to give you 11,880 as your earnings after taxes. And then we have to add back your depreciation, because we're adding back our depreciation because technically depreciation isn't a negative cash outflow. So we're going to be adding that back in, and we end up, sorry, this is pretty tight right here. We end up with annual cash flows of 123,880. Now here, you kind of want to read how long they plan to use it. So here we depreciate for 5 years, but we're using it for 7. So this will be our annual cash flows from years 0 through 5, or 1 through 5 in this case. And we still have 2 more years of the cash flows without that depreciation. So yeah. So I'm going to actually write it on the back of this. I'm running out of space. Just going to put it right here. Okay. So cash flows for years 6 through 7. It's kind of the same thing, except we don't have any depreciation on it. So we're just going to follow the same kind of stuff we have. So we have 180K. We subtract the 50K because we still have the cost, but we don't have to worry about our depreciation because we're done depreciating. And this number will give you 130. You're going to pull out the taxes on that, which is that 34%, and that'll give you 44,200. And after you subtract this out, this will be 85,800. Does that make sense, everyone? You depreciate for how long obviously you depreciate for, but if you use it for longer, you don't worry about that depreciation for the remaining years. So this is initial outlay, cash flows 0 through 5, and 6 through 7. Now we have to worry about our terminal cash flow. Now terminal cash flow is just kind of dispensing of the asset. This can get kind of tricky, so just bear with me. So here, first you want to do is you want to find out how much your book value is of this asset. So off to the side, we're going to find our book value. Now the book value is going to be your depreciable base minus how much you've depreciated. But here, we can kind of infer that since we depreciated for those total 5 years, we have no book value because our depreciable base would be 560, but we depreciated 5 years, and 112 times 5 would be 560 as well. So we end up with a book value of 0. Now, formula for the terminal cash flows would be salvage value plus the proceeds from selling the asset. Let's see, or actually plus or minus, and then add back your net working capital, and that'll be your terminal cash flow. So our salvage value for this for the machine would be 80,000. Yes, that's right here. You're going to sell for 80,000. Yeah. So we're going to sell it for 80,000. So we know your salvage value would be 80. Now the proceeds. Now for you to find the proceeds, you have to do salvage value minus your book value, and that's going to give you whether you have a gain or a loss. Now in this case, we're selling it for 80,000 and it's worth 0. So technically we have a complete gain of 80,000. But you have to subtract the tax from that gain. So you're going to do 80,000 times 34%, or 34%. Now this is all in your practice worksheet. So if you guys can look up those problems as well. All right, so 80,000 times 0.34. Now that's going to give you, you're going to be subtracting, because we have a gain of 27,200. Right, this comes from your taxes on that gain. We're going to add back our net working capital, which is 30,000. Or sorry, that's not a negative, that's a positive. That's positive. And you should end up terminal cash flow of 82,800. Alrighty. So I know this is kind of a long problem, but we want to find net present value. So after you find your initial outlay, your annual cash flows for the years 1 through 7, and your terminal cash flow, you can just plug it in your calculator and find your NPV. So your initial outlay is going to be your cash flow of 0. So I'm going to screw this up. Your cash flow of 0 is going to be 590K. And then years 1 through 5 would be the cash flows of 123,880. Cash flows of 6 would be 85,800. Now you want to be careful on that last year. You have to add your terminal cash flow to that ending annual cash flow for that last year. So your terminal cash flow for year 7 would actually be the 82,800. Actually, this should be 82. Sorry, 82. Could be the 82,800. Oh wait, hold on. Sorry, my bad. This is a 5. I'll just erase that. 85,800. Your terminal cash flows is 82,800 plus the ending cash flow, which is that 85,800 for the years 6 through 7. 85,800. And then your I is going to be 12%. Nope, 13%. Yeah. So here you're just plugging this stuff in the calculator. Sorry, this is kind of sloppy. Yeah. So you're going to plug in your initial outlay of a negative. You have a positive cash flow of years 1 through 5. You have the intermediate cash flow of year 6 of the 85,800, and then your cash flows of year 7, which is the ending annual plus that terminal, and then you have your I 13%. You shift NPV it, and you should get negative 41,409. So in this case, it would actually be a bad idea to do this. That pretty much covers like capital budgeting in a long sense. When it comes to the test, I do not believe in. I don't believe that you'll get a whole problem to do. Most likely, you'll get what is initial outlay or what is annual cash flow, so you don't have to do like this whole problem, I think. But don't count that out. But yeah, that would be your capital budgeting. Does that make sense, everyone? I know it's kind of a doozy because it's really long. Alrighty. Oh, sorry. All right. So, you guys good on this? Okay. All right. So I'm going to move on. Okay. So here, alrighty. So here, all right. This is going to be based on the leverage section, which was chapter 12, and we're going to be doing almost like a little bit of capital structure as well. So here, I wrote this down because I feel like this helps me. I know in the book, and Professor Whiteley uses that triangle of trying to get the increase in your DOL or DCL. This helps me. If you're going from sales, if you're looking to find the increase from sales to operating income, that you're going to use your DOL number for that. If you're looking for your operating income to EPS, you're going to use your DFL. And if you're going from sales straight into EPS, you're going to use your DCL. So that's just kind of like a little thing I wrote down to help me / help you guys, because I don't understand that triangle too much because it's, yeah. So here, and this is also going to be based off formulas you'll be given, so don't worry about memorizing anything. So yeah, number one. If sales increase by 8%, what would be the increase in EBIT? So here, we're going to use our sales to operating income. So we're going to use our DOL number. And the DOL number would be that's the DOL formula. So you're going to be doing sales minus variable cost all over EBIT. And EBIT is actually going to be sales minus variable minus fixed cost. That's your DOL. And here we're just plugging in numbers to find our DOL number. So your DOL number. So sales, we have 950 minus 270 over 950 minus 270 minus 400. So this is just calculating that. All right. So after you calculate that, you end up with a DOL of 2.42. Now what this number does, it tells you that's basically the factor you're going to multiply by to find out what the increase in EBIT is going to be. So we're going to increase by 8%. So you're just going to do 8% times 2.42, and you're going to end up with an increase in EBIT of 1943. So yeah, that's the leverage. Those are the leverage questions. So. Okay. So yeah, it's pretty straightforward. Nothing too tricky there. So yeah. Now here, if sales increase by 7%, what is the increase in EPS? So we're going to use our DCL. Number of ways you can find your DCL. DCL is also DOL times DFL, but there's also the formula which is just going to be sales, yeah. So DCL will be kind of a mixture of DOL and DFL. So sales minus VC over EBIT minus your interest. Yeah. So this is your DCL formula. That's also going to be in the test. Here you're just plugging in numbers. So we know our sales minus VC is going to be 680 over EBIT, which is this number minus another interest expense of 40. I believe that'll be 240. Yeah. So we end up with 240 is going to be your DCL. And your DCL will be $2.83. And here you're just multiplying the same thing, we're just multiplying our increase by that 2.83. And you should end up with 1983 as your increase in earnings per share. Does that make sense, everybody? So yeah, I would kind of try to remember this right here. It's super helpful. Helped me. Yeah. Any questions? You guys are pretty good. Cool. Alrighty. So next question. This is still off chapter 12 and 13 stuff. Your firm expects to earn $448,500 after the taxes. Sales will be 3.5 mil. Fixed costs are 1.3. And here you want to solve for your variable cost. So here you have to kind of write down your income statement to figure out what numbers we'll be dealing with. So, yeah. So the formula for your income statement. Now I'm not sure if that's going to be in the test, but once you know like the top three, it almost falls in line, so it shouldn't be too bad to remember. So it's sales minus your variable costs minus your fixed cost. This is earnings before interest and taxes minus your interest. That's your earnings before taxes. Alrighty. Yeah. So this is kind of the shortened version of the income statement. So I would write this down and try to understand it because it's really helpful when it comes to the next two problems. So here we expect to earn $448,500. So what that means is after taxes. So what that means is you have the bottom number, which is the 448. So let's see, let's put it right here. 448. So we have our 448,500, and we kind of need to work upwards the income statement. So you know here we have taxes here, and we have our earnings before taxes here. We know our tax rate is 35%. So an easy way to get to your EBT, another formula, which I don't think will be on the test, would be your EAT over 1 minus the tax rate. This formula gives you your EBT, which is useful because we still got to work upwards. So here, after taxes is 448,500 divided by 35. Well, 1 minus 35%, which would be 0.65. Yeah. So we're doing 448 divided by 0.65. So when we do that, we end up with an EBT of 690. And I'm just trying to mirror this so that way you guys can kind of see. So we know our EBT is 690. We need to still work upwards. So here we have minus interest, and we know our interest rate is 350. So we need to find our earnings before interest and taxes. So if we know that some number minus 350 gives us 690, then we can find that number by adding these two numbers together. So when you add these two numbers together, you should get an EBIT. I'm going to start it right here now. You should get an EBIT of 1040 or 1.04 mil. And that's from adding the 690 plus the 350. And that gives us our earnings before interest and taxes. So now that you know that, we're trying to find our variable cost. So we know sales is 3.5 mil. Our fixed costs are going to be 1.3. And we don't know our variable cost. So here it just becomes almost like an algebra problem. We're just solving for our variable cost. So one way you can do it is you can kind of switch these two. So you end up actually subtracting your 1040 from everything. So if you do that, that's going to be 3.5 mil minus 1.3 mil minus 1.04 mil. And this would give you your variable cost number. Sorry, my work is kind of all over the place. But so when you subtract all that stuff, you should end up with a variable cost of 1.16 mil. Does that make sense? It's pretty straightforward. You're just kind of working backwards from your earnings after taxes all the way up to your fixed cost, or variable cost in this case. So yeah, that is that. I'll give you guys a minute to write that stuff down. There you go. There, for the people in the back. Alrighty, so next question. Here, it's almost kind of the same thing, except now we're solving for fixed cost, except we do have a little bit of a kind of different setup here. So here, we know that sales is 7.5 mil, and the selling price for their product is $62.50. So what that means is, if you have your sales number and your selling price number, you can find out how many units you're selling. So before we even do anything, we can find out the units. Should end up with units of, I didn't write that number down, but I believe it's 0.5 mil divided by 62.50. So we end up with a number of units of 120,000. Now this is going to be useful later on. So they say net income is projected to be 165. So we're going to be doing the same thing like we did here. So we'll just kind of shortcut some things. If we know net income is going to be 165,750, we can find our earnings before taxes, doing net income, which is 165,750, divided by 1 minus 0.35. So when you do that, you end up with an EBT of 255,000. So with this EBT of 255, we can kind of work upwards our income statement, which is still on the screen. Here, they don't tell us there's any interest, so we can assume interest to be 0, so we don't have to worry about that interest, so we can actually make our EBT our EBIT. So we can just kind of change that here. And here, we're solving for our total fixed cost. So we know sales is 7.5 mil, but they don't tell us our total variable cost, but they do tell us our variable cost per unit. So we're just going to take our variable cost per unit and then multiply it by how many units we actually sold. So we're just going to be doing 38 times 120,000. So we end up with a variable cost, so this is sales, variable cost of 4.56 mil. So now we're just going to do the same thing as we did here. We're solving for fixed costs, so we can kind of switch these two numbers. And we have 7.5 mil. 6 minus 255,000. So we have 7.5 mil minus 4.56 mil minus 255,000. We can find our fixed cost, and our fixed cost would be 2.685 mil. So it's not too bad. It's pretty similar to this one, except you have to worry about your unit. So that's, if you guys see a per unit number, that's a good sign you're gonna have to find the number of units altogether. So I'll give you guys a minute to write that stuff down. Alrighty. So here, I know there are some stock options. So we're gonna do more stocks and shares stuff. All right. So we have 400,000, or this company has 400,000 shares of common stock outstanding, a PE ratio of 8, 500 net income. The board of directors voted in favor for a 3-4-2 stock split. You owned 100 shares before the stock split. How many shares will you own after the split? So this is pretty straightforward. If you want to find out the number of shares after a stock split, you're just going to multiply your shares or the company's shares by that ratio from that stock split. So for instance, we have a 3-4-2 stock split. So you're just going to do the number of shares times 3/2. And that's going to give you your resulting shares from that split. So here they want us how many shares do we own. So we don't have to worry about any of these other numbers. We only care about how many shares we owned at first. So 100 times 3/2, which is just 150. So yeah, it's not too bad. You're just going to multiply by that ratio. And if you want to find the price of the stock split, or the price after the stock split, you're going to multiply by the reciprocal of that. So you can do the price times 2/3. We don't really have a price, but let's say the price was, I don't know, $60. If we can find the new price afterwards, times 2 divided by 3. We have a new stock price of $40. And this is just kind of extra stuff. But yeah, so basically you're just going to multiply, the rule of thumb is multiply the shares by that first ratio, and then multiply that price by the opposite of that ratio, times that. So it's not too bad. It's not too hard. Cool. I'll give you guys a second to write that down if you want. Cool, yeah. Okay. All right, so more stock stuff. All right, so Tech is offering a 10% stock dividend. Now remember, stock dividends basically means you're going to be increasing your number of shares. So if we have a 10% stock dividend, if we have currently 200, we're just going to multiply that by 1.10, and that's going to give us our new shares. So 200,000, I'll just write it down. So the number of shares is 200,000. If we're doing a 10% stock increase or stock dividend, we're just going to be multiplying it by 1.110, and that should be 220. Yeah. So your new shares, so this is old shares. Your new shares will be 220,000. Current price is 48. So stock price is 48. What will be the firm's earnings per share after the stock dividend? Now, I'm not sure if this form will be on the test or not, but this is the PE ratio. So the PE ratio is going to be PE equals the stock price over the net income over the number of shares, or in this case, over EPS. These two are the same thing. I'm not sure if this will be on a test, so I would maybe write this down. So we want to find the earnings per share after the stock dividend. So we're basically solving for this number after our stock dividend. So first what we have to do is we actually have to find our PE ratio to begin with. So let's see, we have if the current price was 48 divided by net income of 800 and then shares of 200. So this is our PE ratio before the split. So we're basically doing 48 divided by 4. So this becomes 48 divided by 4. So your PE ratio to begin with is 12. Now we need to use that same PE ratio to find our new EPS. So we're going to use that same formula. What will be the earnings per share after the stock dividend? Okay, so here you could do actually, all right, so since we have earnings per share after stock dividend. All right. So here I actually kind of went a little too far. We want to find earnings per share, which is just our net income over our shares. So the earnings per share would be net income divided by the new shares. Our net income is going to be 800,000, and our new shares will be 220,000. So I went a little too far with the math. So 800 divided by 220 would be 363 or 364 due to rounding. So here, you would have to do this when it comes to for this problem right here. So we kind of worked on that. So this is going to be 364. Okay. For the previous question, what will be the stock price? So here we're actually trying to find our new stock price. So we found our new EPS of 364, and we know that our PE ratio, our new PE ratio is PE equals SP over EPS. We want to find the new stock price. So for us to do that, it's pretty straightforward. You're just doing the PE ratio times our EPS. So we figured out our PE ratio was 12, and our EPS is now 364. So we're just doing 12 times 364, and you should end up with a new stock price of 43.60. There you guys go. So yeah, we needed to solve for the PE ratio to find our new stock price for the next question. Did you have a question? Oh, the 220,000. This comes from our new stock shares. So if we have a 10% stock dividend, we're adding 10% more stock to our company, and we're at 200,000. So we're just adding 10% on top of that. So it'll just be 1.10 times 200,000, and that'll give you your 220. Yeah. Cool. All right. So that's that. This is more. We can skip this for now. I know there's EBIT. I'll come back to this in a bit, so don't worry about that. Okay, so here we have the EBIT slash EPS analysis. So here, this is just finding out how much interest you have to begin with and how much shares you have to begin with, and then changing that to find what the difference would be for the EBIT. So let's work through that. Okay. So here, we need to find out how much interest and how many shares we have to start with. So interest. Okay. So here they say. So here we have 10 million shares, existing shares, and our debt is 150 million with an 8% coupon rate. So what that means is we're just going to find our interest of doing 150 million times his 8% coupon rate. And that should give you an existing interest of 12 million. So what this is just kind of telling us what we're at right now. And we have two plans that we're going to do that are going to change up those numbers. Okay, so the equity plan, our debt. Okay. All right, so the formula you'll be using is EBIT minus interest times 1 minus tax rate all over number of shares. So this is the formula you'll be using to compare the two different plans. This is an I scribbled that out a little bit. So we need to find out how many new shares or how many new interest we're going to be adding to our equity plan. So it says here an additional 2.5 million shares will be sold at $15 per share. So we need to find out how many shares we're adding, and they straight up tell us we're adding 2.5 million shares. So here we're going to be adding 2.5 million to our number of shares to get us to a total of 12,500,000. And since we're only doing an equity financing, there's no increase to debt or no increase to interest. So we keep our interest the same at 12 million. This is for the equity, and then now we're going to do it with our debt. Oh, sorry about that. So our debt is going to be I equals. All right, so here. Alrighty, so here. I have to go back down. Sorry. Debt financing under this plan, 37.5 million. We'll use 10% long-term debt, so that means we're going to be adding 10% of 37.5 mil. So when you do that, 37, you end up with new interest. So I'll just kind of put here new interest of 3.750. So this is our new interest we'll be adding onto our existing interest. So we'll just be adding the 3,750 to our 12 million. So that'll be 5, 7, 15. And since we're only doing a debt option here, there's no increase to shares. So our shares stay the same at that 12 million or 10 million. Sorry.